Welcome to Finance This, Property That. My name's Dion Fernandes, and this podcast is for property enthusiasts, time-poor professionals, self-employed borrowers, and strategic investors looking for residential or commercial property who want more than just a low interest rate. They want a strategy and a team around them. Each week, I'll share strategies, structures, and lending moves that actually grow wealth, not just get you the loan. And also, I will help you surround yourself with information from professionals in their field. If you're here to build smart, not slow, you're in the right place. My vision is to empower financial legacies for generations. I am a mortgage planner and finance strategist, and I work with doctors, developers, business owners, and high-income earners to build serious property portfolios. So without further ado, let's get into today's episode. Hey everybody, welcome to this episode of Finance This, Property That. Today I want to talk about my favorite topic, which is rooming house lending, because I am a specialist. It's my niche. My niche is debt structure and strategy, but rooming house is one of the asset classes that I deal in with quite a bit. A couple of points that I want to talk about today is stop going to your broker that doesn't actually understand what a rooming house is and how to structure the debt accordingly. What are some of the key changes that have come out for rooming house? We've actually had some lenders pull out and now some lenders come in, and then talk about some of the policies that are in play at the moment and what you need to look out for. And then I want to give you a really, really good example of a exit on a rooming house development that we did for one of our clients and how we did it. So without further ado, let's get into it. Right, rooming house. Stop going to your broker if they don't understand how to do a rooming house, because there are a lot of brokers out there that think they can do it, but they actually can't. It is a really specialized field, and if you don't know the right policies, the right lenders, and more importantly, the right valuer to use, shooting yourself in the foot. Also the right structure. You're shooting yourself in the foot. And sometimes it's actually too late for me to get involved once you've already started working with someone else and they've actually put things in play that they probably shouldn't have put in play. It's really hard to undo. So preparation and talking to us early will really, really help you. I say that all the time. Debt structure and strategy is about being proactive, not reactive. In saying that, I'm still seeing a lot of movement in the rooming house space. They are really in demand. They're a good yield, but they're not for everyone. And I'm going to tell you a little bit about why. They're not for everyone because a lot of people can't afford it. It's just the nature of the type of asset class that you're buying. The reason being is some of the lenders that used to do 80% lends on construction and 80% lend on existing dwellings, even they used to do cash outs, have literally shut up shop. Granite does not do rooming house anymore. They've shut up shop. They didn't provide their own funding anyway. They actually went through Columbus Capital. The lenders that do rooming house are going to cap the LVR for you. So the LVR is sitting around about 65%. LVR means loan to value ratio, 65%. So what that means is you need to have 35% deposit plus costs. If you don't have 35% deposit plus costs, sorry, you're not, it's going to be really hard to do a construction, and it's going to be equally as hard to find you a actual lender that'll go above 65% LVR. A lot of the rooming houses are also above $1 million. So a lot of the commercial lenders will only go up to 65%. There's one that'll only do 50. There's one that'll only do 60. There is one that'll do 80. But it's got to be the right lender for you. So that's where it really comes into it. More importantly, to get to those lenders, you need to have your structure correct. If you have this rooming house or the development or whatever you're doing or the block of land in your personal name, there is literally one lender I can go to, and I'm sorry, you're going to be capped at 65%. Can't say anything more. You got to come to me early. We've got to talk structure. We've got to get ahead of the game. We've got to play smart. And that is how we set you guys up for approval. We set you up for success. Because we work back from the exit, we need to make sure, well, what are we trying to do? How are we going to exit? Or what do we need to do to exit? What do we need to get to entry? And how do we enter with the correct structure? How do we enter with the correct funding stack to actually be able to do it? Long story short, if you don't have at least 35% deposit, it's going to be really hard to do a rooming house right now. Sorry to tell you. But there is some good news. One of my clients has just finished their project. She, like many others, was stuck because she couldn't exit. I did not do the development. If I did the development, I'd already have the exit. But luckily, I know how to exit these things because we do a lot of development or project finance for rooming houses. So this was a very unique style of rooming house. She actually managed to build 3 on one site. So awesome. The biggest issue with that is it's 3 on one site. A lot of the lenders will look at it as in one line. So what in one line means is that you'd have to sell them all, like they look at it as one valuation for all 3 properties. Now, do you really think you're going to get, if each property is valued at 1.5 million, the in one line valuation will not come up to 1.5 million times 3. Come up less, which actually means we've got less equity to play with, which means we've got less strategic financing that we can actually do. So how do we do it? Cool. I started preparing her early. We were having conversations. I personally visited the site to see and understand the actual product that we were getting into. Then we looked at her financials. I actually looked at her existing portfolio outside of her entity and outside of this rooming house. How do we optimize that? How do we get some equity out to be able to complete the exit on the 3 rooming houses? Cool. Then we looked at the rooming house. All right, where are we up to? Who's our property manager? That plays a big part because not all of these rooms were rented out. In fact, none of them were rented out because none of them had occupancy certificates yet. So setting them up to be rented, get the occupancy certificate, get the fire safety certificate, get it all ready to go. She listened. We executed. The valuer and I had a conversation on how we're going to value these things. Great. We also found the funding stack. Now, we did not send all of these to one lender. We split the lending up because we have 3 titles, which means 3 properties. Working with the BDM for lender 1, we took lot 1 and lot 3 because we could actually individually value those because they're not joint. Lot 1, lot 3, we took them to lender 1. We got an 80% lend on commercial terms. Amazing. Yes, we are paying a little bit more on the rate. Agree, but we're also getting an extra 15% LVR. So if you're paying 1.5 to 2% more on the rate, but you're getting 15%, you're netting out at 13. Basic maths. So there is a little bit more complexity to that, but you're still netting out at 13%. We took property number lot 2 to another lender, kept it under sub-million. We were a bit over 65%, but because we were sub-million, we fell under a different class of business lending, which means we could go up to 80% as long as we kept it under $1 million. We were at about 67% LVR because I already knew what the 3 values of each of those properties were going to be. So we kept it under $1 million. That's a pure cash out because we used policy and strategic financing to actually be able to get the cash out for it. It actually just got unconditionally approved today. The lot 2 got unconditionally approved today. Lot 1 and lot 3 already unconditionally approved. They're going to settle next week. Lot 3 is a basic cash. Lot 2 is a basic cash out. So what does this mean? Well, we're releasing almost $1 million in equity to pay back to give, to go and do the next project. We've paid out the loan for the refinance of the existing development debt from lot 1 and lot 3. We're not touching anything from lot 2. We're already planning the next actual site that we're going to go do. Building the portfolio through smart strategy. Go slow to go fast. And we're actually doing it before we sign contracts and before we signing checks we can't cash. So if you are looking to do a rooming house, 1, we got to get organized. 2, you got to have the right team behind you. 3, we have to have the cash and finances to do these things. It is not for everyone, unfortunately. It is a very, very sophisticated asset class that we're trying to, that I don't think every lender is going to feel comfortable lending through on. But if you want to know more, come and find me. I'm very easy to find. I'm all across social media at Dion Finance Specialist on Instagram. Find me on LinkedIn, Dion Fernandes. This podcast has got a website, financethispropertythat.com.au. Find me on the Emerge Finance website, emergefinance.com.au. The information on this podcast is very general in nature. It doesn't take into consideration your personal circumstances. If you want to know more, like I said, come find me. I'm not hard to find. But thanks for listening, and I'll see you on the next episode, and hopefully we're funding your next rooming house.